Right. Let's talk about something that quietly shapes our entire financial world. It's this invisible force that doesn't get the splashy headlines like the stock market, but you could argue it's way more powerful. We're diving into the bond market, the hidden code that runs underneath, well, everything.
And if you want to get a sense of its scale, just look at this number. That's $101 trillion. It's almost impossible to wrap your head around, but that's the size of the global bond market. Think of it like the hidden nervous system of the world economy, constantly sending these little signals that tell us about its health and where it's headed.
So that's the big question, right? How does a market that's really just based on simple loan agreements, basically IOUs, end up holding so much power? How does it control everything from the loan you get for a house to the destiny of entire countries? Well, that is exactly what we are going to unpack.
So, first things first. To really get a handle on its power, we've got to understand how the bond market works as the world's financial backbone. You know, in the industry, they usually call the bond market fixed income. And honestly, that name is perfect, because at its core, it's just a gigantic marketplace for borrowing and lending. This is where governments, huge corporations, and even consumers come to get loans. And investors are the ones who provide that money, in exchange for a fixed, predictable return on their investment.
And right at the very center of this whole global system is the market for U.S. government debt. It is so trusted, so fundamental, that it's earned this great nickname, the world's piggy bank. Seriously, whenever there's chaos or uncertainty anywhere in the world, this is where global money flows to stay safe.
So why? Why this special status? Well, it really boils down to a few key things. First off, U.S. bonds are just seen as the safest place to park your money on the entire planet. That's built on a rock-solid reputation for always paying back its debts. Plus, the U.S. government has the power to tax the wealthiest economy on Earth. And here's the kicker. It has the ability to print the U.S. dollar, which is the world's reserve currency. So, worst-case scenario, the U.S. can literally just print the money it needs to pay its bills.
Okay, so we've seen the gigantic scale of this market. Now let's zoom all the way in. Let's break it down to its most basic building block, a single bond, which, when you strip it all away, is really just a simple IOU.
So here's the key thing to get. When a government or a company issues a bond, it's just creating a fancy IOU that people can then buy and sell. It's a formal promise. It says, hey, if you lend me $1,000 today, I promise to give you these regular fixed interest payments. We call those coupons. And then at the end of the term, I'll give you your original $1,000 back. It's really that straightforward.
And this lays out the whole life cycle perfectly. Step 1, a government needs cash to build a new bridge, so it issues a bond. Step 2, an investor, maybe a big pension fund, buys that bond, which is how the government gets its money. Step 3, for the next, say, 10 years, that pension fund gets a fixed payment every 6 months. And finally, step 4, when those 10 years are up, the government pays the investor their original money back. It's designed to be simple, predictable, and secure.
But wait, if bonds are that simple, why is the market so incredibly complex? Well, it's because once a bond is issued, its price isn't static. It starts to move around in the open market. And understanding what drives those prices up and down is the real key to decoding the market's signals.
Now, this right here, this is probably the single most important rule in the entire bond market. Bond prices and bond yields have an inverse relationship. They are like two ends of a seesaw. When everybody wants to buy bonds, it pushes their price up, but the yield, which is the overall return you get, goes down. And when people are selling bonds, the price falls and the yield goes up. Just burn this into your brain. Price is up, yields down.
So what actually makes those prices and yields move around so much? Well, it really boils down to three massive forces. First is the creditworthiness of the borrower. I mean, how likely are they to actually pay you back? Second is inflation. How fast is the money you're getting back losing its value? And third is the short-term interest rates that are set by central banks like the Federal Reserve. Let's zoom in on inflation for just a second, because for a bond investor, inflation is the absolute arch nemesis. Remember those fixed coupon payments we talked about? They don't change. So if inflation is running high, the real purchasing power of those fixed payments gets eaten away year after year. $100 today just doesn't buy what it did last year. And that's why bond traders watch inflation numbers like hawks.
Okay, so when we take all of this information, the cost of borrowing money across all these different time frames, and we put it all together, we get what might be the single most powerful predictive tool in all of finance. We get the yield curve.
So what on earth is it? Well, the yield curve is really just a graph. It's a snapshot that shows you the interest rate or the yield on government bonds of different maturities, all the way from super short-term loans of a few months to long-term ones that last 30 years. In essence, it's the market putting a price tag on the value of time.
Now, in a healthy, growing economy, the yield curve normally looks like this. It's steep and it slopes upward. And this makes total sense, right? You'd demand a higher interest rate for lending your money out for 10 years than you would for just 3 months, because there's just more risk over a longer period. So this shape is a good sign. It signals that investors are expecting the economy to grow.
But sometimes the curve starts to flatten out. The gap between short-term and long-term borrowing costs gets smaller and smaller. This is a sign of uncertainty. It tells us that the market is starting to think economic growth is going to slow down, and maybe future interest rates won't be as high as everyone thought.
And then, every once in a while, you get this, an inverted yield curve. This is when things get really weird. It actually costs more to borrow money for the short term than it does for the long term. And this is a massive flashing red light. It is one of the most reliable predictors of a coming recession we have, and it's come before pretty much every US recession in the last 50 years. It's a huge signal.
Okay, I know this can all seem pretty abstract. Yields, curves, bonds. But these charts and numbers have a direct and really powerful impact on your everyday life. So let's bring this all back home and connect the dots.
That yield on the 10-year government bond we keep talking about, it directly influences the rate you pay on your mortgage. When it goes up, so does your cost of buying a home. The yield curve also sets the baseline cost for companies to borrow money, to do things like build new factories or hire more people. And finally, it kind of acts like a referee for governments. If a country starts borrowing way too recklessly, the bond market will start demanding higher and higher yields, basically disciplining that government by making it more expensive to operate.
So if you just take one thing away from all of this, let it be this. For all its complexity, the yield curve is really just trying to answer a simple question. What is the price of money over time?
At the end of the day, the bond market isn't just about finance. It's about time. It's the collective wisdom of millions of investors all trying to put a price on the future. And the yield curve? Well, that's its forecast. A hidden code that's trying to tell us exactly where our economy might be heading next. Thanks for tuning in.